This video will help you identify if your beneficiary is considered a non-designated beneficiary, and if so, how to treat required minimum distributions. If you don't know who I am, my name is Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. It's certainly not uncommon that as clients age, they start to inherit money from loved ones who pass on before them. In addition to that, as clients age, they start to take their own beneficiaries a little bit more seriously, especially as it pertains to passing on money to the next generation, where there might be some consequences if not done in the correct manner. One of the most common vehicles that have confusion and certain requirements that follow them are the passing on of retirement assets, such as 401ks, IRAs, things like that. And this is because based on the type of beneficiary that inherits these funds, they're going to have a whole litany of different rules, responsibilities, options, and things like that they need to make sure they get right. Otherwise, they could face some serious tax penalties. Now, most of the time, the default move for retirement accounts like IRAs, 401ks, and things like that, when it comes to naming your beneficiaries, are generally just to name individual people. Generally, first is going to come the spouse as the primary beneficiary, and then as contingent beneficiaries, or kind of second in line, are going to be the kiddos. And usually people split them equally amongst the kiddos. Now, I'm not saying that's the right answer all the time. Of course, your own estate planning should customize what makes sense for your family. But generally, you're going to see individuals listed as beneficiaries. But other times, you might see someone's estate listed as the beneficiary, you might see a trust, and you might even see a charity listed as a beneficiary. And if that's the case, there's certain required minimum distribution rules that follow for those folks, or for those entities. So in today's video, we'll break down how to handle these retirement accounts when the beneficiary is not an actual person. So let's jump in. As a quick refresher, back in 2019, the Secure Act 1.0 was passed, and that broke up beneficiaries of retirement accounts into three distinct categories: eligible designated beneficiaries, non-eligible designated beneficiaries, and then finally, non-designated beneficiaries. Technically, these first two options are considered designated beneficiaries or humans, and this last category is considered a non-designated beneficiary, hence the name, non-designated beneficiaries. Each one of these categories, as I mentioned before, have their own unique set of challenges when it comes to dealing with required minimum distributions. But for the most part, beneficiaries who are not individual people are going to be classified as non-designated beneficiaries. Now, that isn't always the case, and we'll touch on that in just a quick second. So for a quick refresher on what required minimum distributions are, those are the mandatory amounts that must be withdrawn from a retirement account. Whether it's your retirement account or you inherited a retirement account, there's mandatory withdrawals that you need to be aware of so that you're not under-distributing money out of this retirement account and facing a bunch of tax penalties as a result. So generally, if the beneficiary of a retirement account is not an individual person, let's say it's an estate, maybe a trust, or it's made out to go to a charity, those are all going to be considered non-designated beneficiaries. Now, there are some trusts that qualify as either eligible designated beneficiaries or non-eligible designated beneficiaries for the purposes of treating required minimum distributions. And those are going to be trusts like see-through trusts, also known as conduit or accumulation trusts, although those are two different types. And there's also trusts like type 2 applicable multi-beneficiary trusts. Odds are, if you have any of these set up, your attorney and whoever assisted you with this process is aware of these rules, and so you're probably in the clear. That being said, what I'm trying to point out is just because a trust is listed as a beneficiary doesn't necessarily mean that the account will be treated as a non-designated beneficiary account. But let's put that aside. We'll fast forward and say that the beneficiary of this retirement account is either to the estate, it's to a non-qualified trust, or it's to a charity. Let's touch on what the options are, which will be dictated based on whether or not the decedent met their required beginning date or not. For a quick refresher on required beginning dates, that's the date that the original owner of this retirement account was supposed to start taking out required minimum distributions. That's going to be when someone is in their 70s. Now, it's not always good enough just to look at the last investment statement to see if a required minimum distribution was taken out to verify if someone was in their required beginning date or after it, because there's mistakes that are always made. Sometimes people mess up the timing as to when they were supposed to take their first RMD. So it's always best practice just to grab their date of birth, their date of death, and then run it through an online calculator, which I'll link down below. But let's say you've identified whether your original owner of this retirement account was before or on/after their required beginning date. What are the rules? So the rules say that if the original owner, or the decedent in this case, passed away before their required beginning date, then the beneficiary is subject to what's called the 5-year rule. And the 5-year rule, very similar to the 10-year rule we talked about in my earlier video on non-eligible designated beneficiary rules, the 5-year rule simply says that in the 5th year following the date of death, the entire account must be fully liquidated. Now you might be thinking, hey, that's not a whole lot of time, and you're correct. Most of the time, folks are used to hearing of things called like the stretch RMD rules, where the beneficiary can stretch out required minimum distributions over the remainder of their lifetime. For non-designated beneficiaries, though, you're subject to the 5-year rule if the decedent passed away before the required beginning date. One thing to clarify, though, is that 5-year rule, it does not mandate that you take out required minimum distributions in years 1 through 4. So theoretically, the beneficiary, the trust, the charity, whatever, could inherit this money, wait to distribute anything for 5 years, and then fully liquidate the account in the 5th year. Of course, the beneficiary can choose to take distributions out of the IRA if they want to in years 1 through 5, but they don't have to. That's kind of just the minimum bar, is nothing, and then the 5th year, full liquidation. Now, what if the decedent passed away on or after their required beginning date? Well, this is where things get just a little bit more tricky. The IRS stipulates that the inherited funds must follow in accordance with the remaining life expectancy of the decedent, assuming that they were still alive. This is colloquially referred to as the ghost life expectancy rule, or just the ghost rule, where essentially required minimum distributions are mandatory every year following the date of death, and those minimum distributions, required minimum distributions, are based on the life expectancy of the decedent. Now, is this considered a stretch IRA option? I have heard people interpret it that way, whereby the required minimum distributions can be stretched out over the remainder of this individual's passing. Now, again, those are the required minimum distributions that need to be taken out of this account. Theoretically, the beneficiaries could choose to liquidate the entire account all at once if they want to, or accelerate that distribution schedule if, for whatever reason, they see that it makes more sense to get money faster. Now, keep in mind, unfortunately, once the money is taken out of a retirement account, it no longer achieves that tax deferral unless this money is moved into another tax-qualified account. So oftentimes, it's not advisable to liquidate money faster than you have to out of these retirement accounts. But there could be some cases where it makes sense to accelerate the liquidation, even in the cases of a 5-year rule, where it might make sense for the beneficiaries to have access to liquid funds faster than the required minimum distributions dictate. So for example, let's say in today's years, income or revenue is fairly low for the trust or charity, but you imagine in future years, the charitable income or revenue / trust assets might kind of explode in value. It might make sense to accelerate distributions out of the retirement account today so that in future years, you're not paying very high marginal tax brackets on these IRA distributions. One quick note are on Roth inherited accounts, so Roth 401ks or Roth IRAs that are passed on to the next generation. In the same vein, if the beneficiary is listed and they are considered a non-designated beneficiary, the Roth IRA is always treated as having been passed to that beneficiary before the decedent met their required beginning date. So going back to our explanation, that means that any Roth IRA assets that are passed on are subject to the 5-year rule, no required minimum distribution in years 1 through 4, but a full liquidation in year 5. Now, since Roth IRA assets are entirely tax-free, there's a little bit more optionality when it comes to accelerating distributions out of a Roth account because there is no income tax consequences to doing that. However, just like with a pre-tax IRA that's inherited, you do start to lose out on that tax deferral because money is taken out of a qualified retirement account. Now, some of you might be thinking, hey, this sounds like I forgot to take out a required minimum distribution. Didn't Chris mention something back in the day about Notice 2022-53 that talked about relief for certain beneficiaries where if they missed an RMD, the IRS essentially waives that? I want to clarify that that waiver does not apply to non-designated beneficiaries because for the most part, the Secure Act didn't affect non-designated beneficiary rulings. So there's no forgiveness there. If you missed an RMD, speak with your tax professional and get that remedied as quick as possible. And if it wasn't clear by now, I'll make it a little bit more explicit. Generally, labeling your estate as the beneficiary of your IRA is not recommended. For the most part, it makes all the sense in the world to name multiple beneficiaries as individual people, even if it's a contingent beneficiary. It even could make sense to name a trust if the trust is called a qualified trust, a qualified see-through trust like a conduit or accumulation trust. In 99% of the cases, it does not make sense to list your estate as the beneficiary of an IRA because if you pass away, the estate is subject to that 5-year rule or your ghost life expectancy, which for the most part is not the most advantageous of beneficiary designations and required minimum distribution schedules. This is usually a problem for folks who maybe set up their IRA in their 20s and then after 40 years of IRA rollovers or contributions, they just never got around to updating the beneficiary. The default beneficiary on any IRA is the estate of the individual. In addition, this could have happened if, let's say, you're approaching the tax deadline and you wanted to quickly open up and fund an IRA, and so you sort of just hand jammed everything and you skipped the beneficiary designations. That could happen to where now your estate is the default beneficiary. Or, and this would be probably the worst case scenario, your financial team or whoever you're working with maybe pencil whips the account application paperwork or forgets to ask the question, and they just expedite the processing and your beneficiaries are still listed as your estate. While I'd like to think our office never makes mistakes, this is why we implement a cycle of every 2 to 3 years reviewing our clients' estate planning documents and summarizing the beneficiaries, so that we're always double checking and making sure that if something happens, God forbid, that the beneficiaries are getting the money in the way that the owners are thinking that they would. I would say for the most part, if you are a trustee or you are in charge of a charity that is planning on inheriting a retirement account, you would definitely want to seek the guidance of a tax professional to help you make sure that you don't run afoul of these rules, and to share with you what options you have for running these retirement accounts in accordance with IRS rules. So hopefully that was helpful in clarifying who might be considered a non-designated beneficiary, or what might be considered a non-designated beneficiary. If you have further questions, drop me in the chat below or get in touch with the website. Have an awesome rest of the week. We'll chat with you later. Bye.